Few sectors have captured the attention of institutional investors quite like professional sports. Once dominated by ultra-high net worth individuals and family dynasties, sports franchise ownership is rapidly evolving into a recognized institutional asset class, attracting private equity firms, sovereign wealth funds, family offices, and private wealth platforms. At the center of this transformation is Rashaun Williams, founder and chief investment officer of Harbinger Sports Partners, a seasoned investor with early stakes in some of the world's most successful technology companies. Williams is now applying his investment expertise to one of the most exclusive markets in global finance, ownership stakes in elite American sports franchises. In this interview, we discuss sports investing, the growing convergence between private equity and wealth management, how high net worth investors are approaching sports ownership, and Williams' personal journey from venture capital pioneer to one of the leading voices shaping the future of sports investing. Rashaun, thank you so much for joining us today.
Thanks for having me.
Harbinger has just secured more than $450 million for the first fund at a time where we're noticing that institutional interest in sports ownership is accelerating. What does that momentum tell you about how investors are now viewing professional sports as a real asset class?
Yeah, thank you. Our first close for $466 million, our target is $750. So to have a $466 million first close really shows you that the allocators are really interested in more options when it comes to sports private equity. We're very different than our competitors. All of our founders are owners and operators. We're only focused on profitable teams in North America. We have very clear liquidity solutions that others don't have. So we think this opportunity is right. The time is right. And the asset class itself has never performed better. So I know there have been a lot of institutional investors specifically that have passed on the asset class or been on the fence or doing their research. Once they learn a little more about what we're doing, we think we're giving them another option, a better option to invest in sports.
You've deliberately focused on minority stakes in mature NFL, NBA, and MLB franchises rather than building a broader sports platform. Could you tell us about this specialization? Why is it so important in your strategy?
Yeah, it's really about investing in profitable North American teams that are at scale. It's actually not about the NBA, MLB, or NFL. It just so happens that those are some of the leagues that are at scale. And what we consider at scale is if your business model creates profitability for its franchises, right? There are some leagues that just popped up. We call those early stage leagues. Pickleball, CLGP, bull riding, slippery stair racing, slap boxing. They just started. That's like venture risk, right? And then you have growth stage leagues that are still growing. You have WNBA, you have Major League Soccer, you even have hockey, or you have women's soccer. They're not profitable. They're not at scale just yet. But then you have leagues that are at scale that have been around for 100 years. And if you can figure out a way to make private equity or venture-like returns with the low-risk profile of what we call late-stage sports or profitable sports, we think that's a home run policy. Said differently, we don't have to go up in risk to go up in returns. So why would you do it?
Could you tell us more about, how much of success in sports investing comes down to relationships and league fluency rather than, simple financial engineering?
That's a great question. I actually feel like you see me now. You understand exactly what we're trying to do here. Most of our competitors are just doing financial engineering into an asset class that they don't quite understand. They never worked at, they never owned, they never operated, which is okay. That's kind of what private equity does, right? You put some PIK preferreds on something, you put some tag-along rights here, you get some control, you do a roll-up strategy. That's kind of private equity 101. Well, sports doesn't allow you, in some cases, in the big three at least, to even own a control stake. Some of the leagues in the big three won't even allow you to do structured equity. So people have to actually understand the asset class. So when we created Harbinger, we basically took all of the value creation, all of the relationships, and all of the IP of some of the best owners and operators across the big three. Mark Cuban in the NBA, Jonathan Mariner, former CFO of Major League Baseball, Steve Cannon, former CEO of Author Blank Sports, built Mercedes-Benz Stadium, Atlanta Falcons, Atlanta United. We put all of that together, and that IP allows us to underwrite like insiders, like owners and operators, over a 30 to 40 year time frame of knowledge and relationships. So for us, we're using that insider knowledge, relationships, value creation strategies to identify where there's an opportunity, but also to be strategic to the growth of that opportunity and not just financially engineer our way through an ecosystem that we don't understand.
There's also a trend of convergence, I would say, between private equity and wealth management, with private banks and platforms, opening access to alternative assets for high net worth individuals. How are wealthy investors really approaching sports investing today compared to 5 years ago?
Actually, I'll take you one step further in that question. It is a great question. If you think 20 years ago in venture capital or in tech, only really the top 20 VC firms were on the cap table for the biggest tech companies. And then they only raised from pensions, endowments, and foundations. Then you saw the VC firms go downstream and started raising from wealth management platforms. Today, what you're seeing is the reverse order. You're seeing wealth firms go direct on the cap table for hyper-growth venture firms, which has never happened before. Have you ever seen a wealth management firm leading a Series B for an AI company? This is an unheard of precedent transactions, right? So when VC firms are now looking for liquidity, they go downstream. They go to the wealth platforms. They find individual high net worth individuals, and they sell their positions via SPVs to a new category of people who never had access to the asset class. Sports today, from a liquidity standpoint, is where tech was 10 to 15 years ago. Right now, it's being gatekept by a few large private equity firms. Those private equity firms largely raise from pensions, foundations, and endowments, but are starting to raise from wealth management platforms. Eventually, the wealth management platforms will skip over the private equity firms altogether and be able to create SPVs that go direct on the cap table. It's not happening today, but it will happen in the future just like it happened in tech. So it's a fascinating time for liquidity.
Speaking of liquidity, you're well known for talking about secondaries. Could you please elaborate on that point?
Secondaries are the new primaries for private and liquid assets. Buying shares from people who are already on the cap table instead of waiting for this company to issue new shares is common practice in venture. It is also common practice in sports. People just don't know about it. The majority of the transactions are people selling shares they already own, not new shares being issued. So sports is ripe for this whole secondary market that has already been developed in tech, over a decade ago, to take advantage of that and leapfrog 10 to 20 years that it took tech to kind of figure it out. So I'm very interested in how secondaries will play a role in sports liquidity over the next decade.
Many will argue that owning a sports team is a trophy asset that in fact doesn't make money. What's your view on that?
Well, I mean, it's true, but you have to separate sports into three categories. That's like someone saying you can't make money in tech or startups. Well, there's early stage tech and startups where 90% fail. Then there's growth stage where 50% fail. But then there's late stage. I think if you invested in SpaceX a year ago or Anthropic a year ago, these companies are bigger than the majority of the companies in the S&P. So is that the same risk profile as a startup? So sports are the same way. There are leagues that are profitable that have been around for 100 years. And then there are leagues that just popped up last week. So all sports aren't the same. So if the question is which categories are riskier and which categories are vanity investments, then we can segregate the categories by early growth and late. But I can tell you one thing, late stage sports, the profitable sports, used to probably be a vanity investment in the 90s, maybe early 2000s. It is not the case anymore. Some of the guys buying teams aren't even sports fans. I'll give you a prime example. I was a part of a group bidding for the Washington Commanders before I launched Harbinger. The guy who was leading my group had never watched football before. Why was he interested in buying a football team? He didn't even live in America. And why was he interested? It's a non-correlated asset. It has bond-like risk. It's a legal local monopoly. Revenue and valuations are growing at a higher CAGR than the S&P 500. It has scarcity. And it's a tax-free money bucket because of depreciation and goodwill amortization, which is section 197 of the IRS tax code, goodwill amortization. You could amortize the goodwill value of a sports team over 15 years and pull out cash flow tax-free for 15 years. So You ask any billionaire or any wealthy person, the holy grail to your investment portfolio is finding something that's non-correlated, that is also growing at a higher CAGR than the S&P, that is a tax advantage asset, that has the lower risk profile like bonds. There's nothing else out there like sports. And ironically enough, the only thing that has a close revenue profile is enterprise software. If 80% of NFL teams' revenue is annual recurring contractual revenue, yeah, it should trade at the same revenue multiple as software companies, which trade at 10 times revenue. That's why NFL teams trade at 10 times revenue. But if 80% of your revenue is ticket sales, you shouldn't be traded at enterprise software multiples. You should probably be trading at a multiple of EBITDA.
Very clear. And so franchises, we're seeing valuations that, I mean, continue to break records across US sports. Where do you still see inefficiencies or opportunities that the broader market may be overlooking today?
The franchise valuations are growing, but what people are missing is actually revenue that's growing. Multiples are kind of flat, right? So revenue is breaking records. It's media deals, it's league sponsors, and then it's local revenue. There's an entire inflection point that we're at in sports right now, which is going to drive value creation over the next decade or so. We call it Sports 2.0. The old 1.0 model was when the leagues nationalized their media rights and they started sharing media. They became profitable, their revenue grew, and now they just contribute all of their IP into one media package. They sell it to distribute it to the Amazons, the Netflix, the Disneys, the Paramount, and the Foxes of the world, right? That's the old model. The new model is I want to take that annuity of cash flow, which is on a 10 to 12-year contract, but I also want to diversify revenue into what we call Sports 2.0. And that's, for the first time, own my own stadium, rent it out when I'm not using it, own all the real estate around the stadium, monetize that fan base 365 days a year. So now you took a ball club that was only being monetized 10 times a year at home, and now you're monetizing 365 days a year. You're not sharing that revenue with the league or the players, so it's higher margin business. And every time you see a new team that's acquired, what's one of the first announcements you see? New stadium. Real estate adjacent around the stadium. The reason for that is because of the Sports 2.0 thesis. It's how they're driving revenue growth over the next decade. That doesn't mean that media rights still won't increase. I think they will increase, but at a decreasing rate. But I think where a lot of the value is coming from is the landlord model, what the Dallas Cowboys are doing, right? What Jerry Jones is doing in Dallas, what the Atlanta Braves are doing. Publicly traded company. You can look it up. To give you one anecdote, the Atlanta Braves, this article was just written in the Wall Street Journal maybe 6 months ago, went from $250 million in revenue when they were operating at Sports 1.0 to $650 million in revenue operating in Sports 2.0. All they did was move 10 miles north in Atlanta. So I'm here in Atlanta. They were at Turner Field, leasing the stadium. They moved to Cobb County, built the stadium, owned the stadium, rented out for concerts and events. They also own the restaurants, the bars, the parking lots, the commercial, the residential real estate, the movie theaters. And it's an entire district now. And you can see all the financials. It's a publicly traded company. So that's the new model. That's where the value creation is coming from over the next decade.
But this is also linked to being able to really create a fan-centric brand that brings a community together. Is there enough bandwidth for every team to do that thanks to geography?
No, and it will vary based on geography, just like you said. There's something that we do internally. We use predictive analytics to do something we call demand modeling, and it answers that question. Is there pricing power to generate revenue locally based on the local demographics, right? Cleveland is going to have a different, monetization plan than a Miami, a New York, a LA, or an Atlanta, right? Beyonce and Taylor Swift, when they tour the nation, probably won't stop in Cincinnati, but they will stop in New York and Chicago, right? So you have to factor all of these things in. But even if you grew 100 million in revenue just by creating a new stadium when you have more premium, right? Where you have more suites, where you can have better sponsors, at 10 times revenue, that's $1 billion in value creation on your valuation. But the Dallas Cowboys, what are they doing? 1.2 billion in revenue. They're driving 5 to 700 million of revenue growth locally. That's a $5 to $7 billion value creation. Less than 20% of teams in the big three own and control their stadium and real estate, and half of the stadiums need to be replaced. So if you just extrapolate out 92 teams, we're in this replacement cycle where you can drive revenue growth by 100 million to 700 million. That's $1 billion to $7 billion in value creation times 92 teams. We're talking about $300 to $500 billion in value creation just from diversifying your revenue from Sports 1.0 to 2.0. That's a huge opportunity. and a fantastic inflection point, which is one of the reasons why we don't feel the need to go into riskier sports assets. We can get the same returns in the safest assets because of the timing.
You emphasize being a long-term strategic capital partner rather than a traditional financial sponsor. What does that look like in practice when working with ownership groups?
Yeah, well, as you probably know, you can't be a control owner in some of these leagues. But what happens with us is when people are looking, when you acquire a team and you put $2 to $4 billion of your own money in, or when you relocate your team and you put $1 billion of your own money in to relocate, when you build a new stadium and you put $1 billion of your own money in, and you're thinking about investors that you want on the cap table, the first question is, do I just want financial investors who are going to try to put preferred equity on top of me and I have all of the skin in the game? Or do I want strategic investors who can help me avoid mistakes, right? So I think we get invited into opportunities because we're strategic. When operators and owners get on the phone with us, they're usually picking our brains. They're like, what are you doing locally to drive revenue in the NBA versus MLB versus NFL? Or what are some of the mistakes you made building the stadium that you built down here when you were the CEO? Or, you've been through 4 different player strikes and lockouts or media deals as the CFO of Major League Baseball, or you set up Baseball Endowed Limited Partners, which is the strike fund that Major League Baseball has. What is your estimate on how this manifests, in the P&Ls of all baseball teams if we go on strike? Those are the questions that we get. And we're not forcing our opinions. We are a complement, but not a substitute to a good operator and to a value creation plan. So we get invited to opportunities, and people love having smart people at the cap table. Very similar to the venture capital industry, where Andreessen Horowitz, Sequoia, Kleiner Perkins, they'll own 5% of a company, but they're very strategic because they backed Airbnb, right? They back Pinterest. So that entrepreneur wants their opinion. They're not forcing their opinion. Entrepreneur just wants it. So we want to bring that type of energy to sports. We want to be the Andreessen Horowitz for sports private equity, right? Surrounding founders or owners and operators with the best brain trust in sports that has skin in the game, that have owned and operated and been in that seat, and just offering advice when you need it, not forcing it, just when you need it.
So moving on to this Sports 2.0, does that mean that, for example, when you build a stadium, you bring in other investors that could be only interested in the real estate, or you just keep it all within your initial group?
And the advantages are when it's in the same holdco and you get the synergies, right? You want to monetize. You want to be in the holdco that has the stadium, that has the team, that has another team, that has all of the real estate. Because remember, the holdco is going to trade at that revenue multiple, right? Mm-hmm. So it's in your best interest to grow revenue as much as you can in the same holdco, using that team as the anchor tenant. If you move that team out, I'm not sure that real estate and all the rest of the stuff is worth as much, right? This is not a sum of parts. The real value is that anchor tenant that's generating all that cash flow, which can cover a lot of the capital calls for the losing entities in it, but also is driving all of that traffic to that area. And you want to fill that traffic and you want to monetize it 365. So you definitely want to be in a holdco as opposed to the individual assets underneath.
I'd like to move to your personal journey and your investment philosophies. So your journey from Chicago South Side to venture capital, Wall Street, and now sports ownership is quite remarkable. What experiences most shaped your mindset as an investor and as an entrepreneur?
Well, I think coming from poverty, I came from the South Side of Chicago. And I was very curious how the wealthiest people in this country built wealth and maintained it and passed it down. And when I first started my career, I went from being on the South Side of Chicago, standing on my curb, looking at the Sears Tower downtown, to actually working at the Sears Tower for Goldman Sachs. And that was an eye-opening experience for me. So I learned, kind of how the markets worked from Goldman Sachs, from Wall Street. Like I had a blank canvas. I knew nothing about money, learned everything from there. And this has really shaped how I approach things now, because I know what it's like to not have money. So when I invest in things, I'm looking at the risk associated with it. I've been through cycles. I remember what happened in 2000 and in 2001. I was at Goldman. I was in the Sears Tower when 9/11 happened, when the tech bubble happened. I was at Wachovia in 2008. So for me, when I started investing in sports teams, I was trying to diversify outside of tech. I made so much money in tech. I was an early investor in Coinbase and Robinhood and Dropbox and Lyft. But I remember 2008, and I was at Wachovia when everything was correlated to real estate. So I started thinking, how do I diversify outside of tech? And sports, specifically late stage sports, were non-correlated because of the annual recurring contractual revenue streams that they have. So I started investing in sports, and my opinions and my investment strategy has been informed by all of the cycles that I've seen since 1999, by coming from fixed income. Like when we look at our portfolio, we're literally targeting bond-like risk with private equity-like returns. I'm a bond guy. I'm a credit guy. And I also have put my money in every asset that I've started funds in. I started as an investor first, figured out the arbitrage, which I learned on Wall Street. How do you make money in this asset class? And that's really been guiding our strategy. And the last thing I did with Harbinger, I said, man, I really want to have partners that are much smarter and much more experienced than me, and really partner with the smartest guys in the sports business. And it's been fantastic. And our investors are really excited about what we're doing.
Also speak frequently about ownership, access, and wealth creation. So how important is it for you personally to help broaden participation in alternative investments and private markets?
In 2000, I started this nonprofit called the Kemet Institute, and I've been teaching financial literacy to the underserved communities for 26 years now. And it all started when I read this book called Why Should White Guys Have All the Fun? Have you ever heard of that book?
No,
You should look it up. It's an
will.
autobiography of a guy named Reginald Lewis, this African-American guy who went to Harvard Business School, got to Wall Street, and he did this $1 billion like leverage buyout in the 80s. And my mom gave me that book. And when I read that book, I was like 12 or 13 years old, and my mom wrote in the cover, "This will be you one day, son." And she didn't know anything about private equity, right? So now, fast forward, I'm actually doing private equity. But I've always had this long-term plan. When I started on Wall Street, I wanted to be an advisor where I can build a skill set, build my balance sheet, build my relationships. I was going to do that for 10 years, and I did that. And then I wanted to be an investor. So I launched my first VC fund, Queensbridge Venture Partners, and then I did 4 additional funds with Manhattan Venture Partners afterwards. Last fund was $1.5 billion. We were averaging 30 to 50% returns. So I did the investor thing, writing small checks in a bunch of companies. And now I'm on the third 10-year trek where it's about ownership, to answer your question. And I'm just trying to do what I have learned the people ahead of me have done to build wealth, right? If you come from nothing, build a skill set, build your relationship, build your balance sheet, then you become an investor yourself, and then you continue to invest, build a track record, and then you can write bigger checks and be an owner of things. So I've been looking to be an owner. That's why I wanted to be a minority owner of the Atlanta Falcons. That's why I wanted to start Harbinger Sports Partners, which is why my family office acquires lower middle market businesses. So this has been a 30-year plan, kind of written by a 12-year-old who read a book and was inspired by his mom. But I've also been teaching along the way. I didn't just wait until I made it before I started giving back. So I teach free classes at Morehouse on venture capital. I mentor over 100 athletes and entertainers, and even on social media and on Shark Tank. I try to spend as much time teaching so people who don't have access can learn from a guy like me.
Inspired by his mother. For me, this is
Yeah,
the
that's
role of the
right.
family, and the mother is quite important, and it's a beautiful story. As you mentioned, you meet a lot of high net worth individual, high profile individual. What is the biggest mistakes you see some of them do, especially when investing in sports?
A lot of people don't know that there are different prices for each sports teams. Like they'll charge a premium to some people get it at a discount. And a lot of people are focused on how much the valuation has grown. That's not really, you have to focus on cash flow, right? Like every time a team raises money at a higher valuation, they need to raise money in order to fund losses most of the time. And the higher valuation is just a price that they pulled out of the sky, right? And they have an incentive to grow the valuation. So what I've noticed is that people with money all want NFL, NBA, or MLB. They trickle down to the other leagues for a variety of reasons. They're looking for higher growth. They want a larger percentage. The check sizes are too big for the big three, or nothing's available. So it's a big world out here. There's so many different leagues and so many different sports. The best advice I can see, just based on my vantage point, is understand the risk and return profile And when you're a sports team owner, you actually want to be involved. Maybe try to focus on something in your region, right? Like I love all of the European soccer leagues and Australian basketball leagues, but for me, it was important to do something in Atlanta. That's why I'm very thankful that Arthur Blank gave me the chance to be an LP for the Atlanta Falcons. So try to find something local, understand the tax benefits, and look at the capital call history of these particular teams, because you're going to have to write a check in the future to keep it afloat, or you can get diluted significantly if you don't.
When people look back at your career years from now, what do you hope Harbinger Sports Partners will have changed about the business of sports ownership?
Mark Cuban has gone publicly and said he thought private equity for sports is a bad thing. And the reason that he said it is because private equity firms are mostly concerned about the valuation increasing and then financially engineering their way into this asset class. And when you lose track of the fan experience, the content and the IP isn't as valuable, which means the media rights won't be as valuable, which means the revenue will drop, which means the valuations will drop. So he's very conscious and a fan first guy. Lowest price tickets, best coaches, and all of these things. We hope to continue that legacy that he started in 1999 when he bought the Mavs in a way that's supportive, that's a complement, but not a substitute to a team. We want to identify the teams that we think value that. We want to support them with capital. We want to reinvigorate their LP base by providing liquidity to them. And we want to be strategic advisors. We do not want to be what private equity has known to be in other industries, which are value destroyers, not necessarily value creators. So we hope to be that partner on the cap table that is someone that can be accretive to these managers and these owners executing their value and their growth strategies.
Rashaun, thank you so much for your time.
Thank you so much. I appreciate your time. Nice meeting you.